Welcome to the Accounting Times channel. A series of episodes containing a bank of questions for the CMA certificate, the first part, from various sources. Follow the channel to receive all the questions with the answers explained in detail. Please do not forget to like the channel to support us in completing all the questions. A1. Financial statements.
Question 1. Dividends paid to company shareholders would be shown on the statement of cash flows as A. Cash flows from investing activities. B. Operating cash inflows. C. Cash flows from financing activities. D. Operating cash outflows. The answer is C. Cash flows from financing activities. Dividends paid to company shareholders would be shown on the statement of cash flows as cash flows from financing activities. Financing activities include all long-term debt and shareholders' equity transactions. Question 2. Which one of the following should be classified as an operating activity on the statement of cash flows? A. The purchase of additional equipment needed for current production. B. A decrease in accounts payable during the year. C. The payment of a cash dividend from money arising from current operations. D. An increase in cash resulting from the issuance of previously authorized common stock. The answer is B. A decrease in accounts payable during the year. A decrease in accounts payable during the year should be classified as an operating activity on the statement of cash flows. The proceeds from the issuance of stock and the payment of a dividend are financing activities. Purchase of equipment is an investing activity. Question 3. All of the following are limitations to the information provided on the statement of financial position except the A. Judgments and estimates used regarding the collectability, salability, and longevity of assets. B. Lack of current valuation for most assets and liabilities. C. Omission of items that are of financial value to the business such as the worth of the employees. D. Quality of the earnings reported for the enterprise. The answer is D. Quality of the earnings reported for the enterprise. Earnings for the enterprise are reported on the income, not the statement of financial position, i.e. the balance sheet. Question 4. Pierre Company had the following transactions during the fiscal year ending December 31st, year 3. Asterisk sold a delivery van with a net book value of $5,000 for $6,000 cash, reporting a gain of $1,000. Asterisk paid interest to bondholders for the amount of $275,000. Asterisk declared dividends on December 31st, year 3, of 8 cents per share on the 1.3 million shares outstanding, payable to shareholders of record on January 31st, year 4. No dividends were declared or paid in prior years. Asterisk accounts receivable decreased from $70,000 on December 31st, year 2 to $60,000 on December 31st, year 3. Asterisk accounts payable increased from $40,000 on December 31st, year 2 to $45,000 on December 31st, year 3. Asterisk the cash balance was $150,000 on December 31st, year 2, and $177,500 on December 31st, year 3. Which of the answers below describes the correct entry for Pierre Company's statement of cash flows on December 31st, year 3 using the indirect method? A. The decrease of $10,000 in accounts receivable is reported as a $10,000 decrease in the operating section of the statement of cash flows. B. The $104,000 dividend payout is represented as an outflow of funds in the financing section. C. Financing activities include the $1,000 gain from the sale of the delivery van. D. The $1,000 gain from the sale of the delivery van is included in operating activities as a deduction. The answer is D. The $1,000 gain from the sale of the delivery van is included in operating activities as a deduction. Under the indirect method of cash flow statement preparation, net operating cash flow is determined by adjusting net income. Using the indirect method, the full $6,000 received for the asset sale is included in the investing activities section. Since the $1,000 gain is already included in net income, it must be deducted so as not to be double counted. Question 5. Pierre Company had the following transactions during the fiscal year ending December 31st, year 3. Asterisk sold a delivery van with a net book value of $5,000 for $6,000 cash, reporting a gain of $1,000. Asterisk paid interest to bondholders for the amount of $275,000. Asterisk declared dividends on December 31st, year 3, of 8 cents per share on the 1.3 million shares outstanding, payable to shareholders of record on January 31st, year 4. No dividends were declared or paid in prior years. Asterisk accounts receivable decreased from $70,000 on December 31st, year 2 to $60,000 on December 31st, year 3. Accounts payable increased from $40,000 on December 31st, year 2 to $45,000 on December 31st, year 3. The cash balance was $150,000 on December 31st, year 2, and $177,500 on December 31st, year 3. What is the net effect of taking the total cash provided, used, by operating activities, adding it to the cash provided, used, by investing activities, and adding that to the cash provided, used, by financing activities? A. Positive cash flow of $27,500. B. Negative cash flow of $371,000. C. Positive cash flow of $22,500. D. Negative cash flow of $366,000. The answer is A. Positive cash flow of $27,500. The total cash provided, used, by the three activities, operating, investing, and financing, should equal the increase or decrease in cash for the year. The difference between the beginning balance of cash of $150,000 and the ending balance of cash of $177,500 is equal to $27,500. Question 6. Asterisk an item of inventory purchased for $30 had been incorrectly written down at the end of last year to a current replacement cost of $22. The item is currently selling for $60, its normal selling price. The error will affect the financial statements in which of the following ways? A. The income for this year will be overstated. B. The income for this year will be unaffected. C. The cost of sales for this year will be overstated. D. The income for last year is overstated. The answer is A. The income for this year will be overstated. Since the inventory item had been incorrectly valued at $22 instead of $30 at the end of the previous year, the current year cost would have been lower by $8, resulting in higher overstated net income for the year. Income for the prior year was correspondingly understated. Question 7. When using the statement of cash flows to evaluate a company's continuing solvency, the most important factor to consider is the cash. A. Flows from, used for, investing activities. B. Balance at the end of the period. C. Flows from, used for, operating activities. D. Flows from, used for, financing activities. The answer is C. Flows from, used for, operating activities. When using the statement of cash flows to evaluate a company's continuing solvency, the most important factor to consider is the cash flows from, used for, operating activities, since over time, cash flow from operations has to cover everything. Question 8. Pierre Company had the following transactions during the fiscal year ending December 31st, year 3. Pierre Company had the following transactions during the fiscal year ending December 31st, year 3. Asterisk sold a delivery van with a net book value of $5,000 for $6,000 cash, reporting a gain of $1,000. Asterisk paid interest to bondholders for the amount of $275,000. Asterisk declared dividends on December 31, year 3, of 8 cents per share on the 1.3 million shares outstanding, payable to shareholders of record on January 31, year 4. No dividends were declared or paid in prior years. Asterisk accounts receivable decreased from $70,000 on December 31, year 2 to $60,000 on December 31, year 3. Asterisk accounts payable increased from $40,000 on December 31, year 2 to $45,000 on December 31, year 3. Asterisk the cash balance was $150,000 on December 31, year 2, and $177,500 on December 31, year 3. Pierre Company prepared its statement of cash flows using the direct method on December 31, year 3. The interest paid to bondholders is reported A. as an outflow of cash in the investing activities section. B. as an outflow of cash in the operating activities section. C. as an outflow of cash in the financing activities section. D. as an outflow of cash in the debt servicing activities section. The answer is B. as an outflow of cash in the operating activities section. This is a payment of interest on a debt obligation. The payment of interest to bondholders is considered a cash outflow from an operating activity. Question 9. Suzanne Rogers, a financial analyst, is analyzing Capital One's stock. She is more interested in estimating the cash flows it can generate. From the financial analyst's perspective, which of the following balance sheet reporting is best suited to avoid adjustments? A. Inventory reported at current market value, fixed assets reported at historical cost. B. Inventory reported at replacement cost, fixed assets reported at market value. C. Inventory reported at historical cost, fixed assets reported at market value. D. Inventory reported at historical cost, fixed assets reported at fair value. The answer is D. Inventory reported at historical cost, fixed assets reported at fair value. The current market value of inventory closely reflects the value at which it can be sold. Fixed assets reported at historical cost will help to estimate depreciation expense. Correctly to estimate the tax shield from depreciation. Question 10. At the end of the current fiscal year, XL Company reported net income of $40,000. In addition, the following information is available. Using the indirect method, what amount should be reported as cash flow from financing activities on Excel's statement of cash flows for the current fiscal year? $6,500. B. $9,500. C. $39,500. D. $20,500. The answer is C. $39,500. The cash flow provided from financing activities is computed by taking the increase in notes payable of $1,500, adding the increase in additional paid-in capital of $3,000, less the decrease in long-term debt of $12,000, plus the increase in common stock of $1,000, less the entire amount of the cash dividends paid, not the increase/decrease from prior year, of $33,000. Question 11. A statement of financial position provides a basis for all of the following except A. Evaluating capital structure. B. Assessing liquidity and financial flexibility. C. Determining profitability and assessing past performance. D. Computing rates of return. The answer is C. Determining profitability and assessing past performance. A statement of financial position provides a basis for computing rates of return, evaluating capital structures, and assessing liquidity and financial flexibility. The income statement determines profitability and assesses past performance. Question 12. Juan Baker Incorporated filed a suit against Foster Desserts in the second quarter of the current year and claimed damages worth $15,000. There was also a pending litigation against Juan Baker Incorporated for $12,000 to its suppliers for supplying lower quality goods. The company was expecting to win the suit against Foster Desserts. For presenting the financial statements for the year, Juan Baker's accountant realized a net gain of $3,000 as other comprehensive income. As per U.S. GAAP, how should this information be presented? A. The accountant should recognize contingent liability of $12,000 and disclose contingent gains of $15,000 as footnotes. B. This information should not be presented as part of financial statements but should be disclosed in footnotes to financial statements. C. The accountant should realize net gain of $3,000 as part of gains from extraordinary items. D. This information should not be presented in financial statements but should be disclosed in the director's responsibility statement. The answer is A. The accountant should recognize contingent liability of $12,000 and disclose contingent gains of $15,000 as footnotes. Accounting recognition is not given to gain contingencies to avoid the premature recognition of income before its realization. However, loss contingencies must be recognized when it is both probable that a loss has been incurred and the amount of the loss is reasonably estimable. Question 13. Which of the following financial statement changes would best represent the impact of incurring and paying interest on a note payable for the period? A. Effect on equity section of the balance sheet, no effect statement of cash flows direct method, outflow from operating activities. B. Effect on equity section of the balance sheet, decrease. Statement of cash flows direct method, outflow from operating activities. C. Effect on equity section of the balance sheet, no effect statement of cash flows direct method, outflow from financing activities. D. Effect on equity section of the balance sheet, decrease statement of cash flows direct method, outflow from financing activities. The answer is B. Effect on equity section of the balance sheet, decrease. Statement of cash flows direct method, outflow from operating activities. Interest incurred during the reporting period on a note payable is considered an interest expense on the income statement, which reduces net income and in turn decreases the equity section of the balance sheet. Interest expense paid is considered an operating activity as it is used to pay for the day-to-day operating activities of the organization. Therefore, for statement of cash flow purposes, interest expense paid would be classified as an outflow from operating activities. Question 14. Perry-Avon Corporation is engaged in the manufacture of cargo ships. The company wants to avail itself of a long-term loan from Wealth Bank and has provided the following information. The current assets, as per last year's balance sheet, include inventory of cargo ships of $2,250,000 and $300,000 of accounts receivable. The amount of inventory includes cargo ships lying in stock for 18 months, and the amount of accounts receivable includes accounts due for 90 days. The company grants a credit period of 60 days to its customers. The bank manager decided to grant the loan, as the current ratio of the company was 9.44. As per the bank's credit policy, a company is eligible to avail itself of loans if its current ratio is more than 2.5. However, the bank's credit analyst disapproved the manager's decision, as he recalculated the current ratio to be 1.11 based on some adjustments. Which of the following, if true, will support the credit analyst's decision? A. The credit analyst did not consider the accounts receivable for the calculation of current ratio as they should be classified as bad debts. B. The current liabilities were inflated due to the principal payment of loans in the previous year. The bank manager ignored this fact. C. The credit analyst did not consider the impact of an increase in inventory and accounts receivable due to inventory worth $10,000 purchased on credit. D. The credit analyst feels that the company's liquidity is overstated because of the inclusion of cargo ships as current assets. The answer is D. The credit analyst feels that the company's liquidity is overstated because of the inclusion of cargo ships as current assets. The inventory of cargo ships has been lying in stock for 18 months. Therefore, considering the value of inventory in the calculation of current ratio will not provide a true picture of the company's liquidity. Question 15. Selected financial information for Christina Company for the year just ended is shown below. Christina's cash flow from investing activities for the year is A. $1,220,000. B. $1,300,000. C. $1,500,000. D. $2,800,000. The answer is B. $1,300,000. The cash flow from investing activities is calculated as cash received from the sale of available-for-sale securities minus cash paid for the acquisition of land, or $2,800,000 minus $1,500,000 equals $1,300,000.